Every year, more than $120 billion of viable African trade goes unfinanced.
And it isn't because the goods don't exist, nor because the buyers aren't ready,
but because the financial infrastructure to carry the transaction through, the trust infrastructure, was simply never built for people like us.
Trade finance is the oldest financial instrument in the world. Deep at its core, it is really just a mechanism of trust, a way for a seller to be certain they will be paid, and a buyer to be certain they will receive what was sold.
In practice, that trust is expressed through ancient instruments, such as a letter of credit, a document issued by a bank guaranteeing payment once agreed conditions are met, used for centuries. The gold standard of international commerce.
But here is the problem. That instrument, in the form most African small and medium exporters encounter it, is paper-based, prohibitively expensive, and functionally inaccessible to any business that isn't big already.
The African Development Bank puts the continent's trade finance gap at over $100 billion a year and growing. For Ghana alone, the estimate is at least $7 billion.
SMEs, small and medium enterprises, make up more than 90% of businesses across Africa and over 60% of jobs. They are not some peripheral footnotes to African economies.
They are the economy.
And yet the system that was designed to connect producers like her to buyers in London or Hamburg or Tokyo was never built with her in mind. The lift simply does not uplift. The levers are stuck.
Over the past 2 decades, international banks have withdrawn from Africa at scale, a process called de-risking. Compliance costs, perceived sovereign risk, and the burdensome weight of international banking regulation have made them retreat.
African banks have lost nearly 40% of their correspondent banking relationships in recent years. In some cases, the Nostro accounts they're required to maintain with international banks now lock up so much cash that there is pretty little left to deploy at home.
And even where relationships remain, the hurdles are formidable. Know your customer checks, anti-money laundering screening, document verification. Each one a reasonable requirement in isolation, but together forming a wall that keeps the smallest yet most dynamic businesses permanently locked out.
The irony is that modern neobanks and electronic money institutions in the UK have exactly the tools to solve this: sophisticated compliance technology, risk appetite, and of course, digital rails. Oh, and deep pools of capital all around. But they lack the cross-border networks to deploy them in Africa. 2 worlds, equally capable, talking past each other across an ocean.
Neofingo is a digital finance corridor. At its core is a new class of financial instrument, the Neo LC, a digital letter of credit, designed for the world as it actually is, mobile, AI-enabled, and built on open standards.
The Neo LC is not a merely digitized version of its paper predecessor. It is programmable, it meets all the international standards, and it is accessible to an SME on a mobile phone in Kumasi in the same way it is accessible to a trade desk in London.
The SME exporter connects to the Neofingo corridor through a mobile or desktop interface within the existing fintech environment. An AI assistant, Nomi, guides them through letter of credit creation, document validation, and submission, step by step, in plain language.
Nomi translates the language of international trade finance, a language that even experienced bankers find dense, into guided conversational workflows. The expertise oozes comfortably from the system. The user simply has to show up with their goods and their ambition.
And on the liquidity side, a Nostro-light settlement model, where African fintechs hold settlement accounts with London neobanks, but post dramatically less cash collateral than traditional correspondent arrangements require. Because of the AI-enabled shared data environment, that freed up capital stays in the African economy.
In time, a network of development finance institutions shall provide guarantee facilities to scale this up. Risk shared, ambition enabled.
The Neofingo protocol does not operate outside of policy. It is designed to work with regulators, not around them.
The Bank of Ghana's regulatory policy sandbox, a controlled, supervised environment in which the protocol's proof of concept can be tested, evaluated and refined, shall provide full regulatory visibility, innovation and accountability sitting together at the same table. That's the winning formula.
The United Kingdom's Electronic Trade Documents Act 2023 solved a problem that had blocked digital trade for decades. The question of legal ownership of an electronic document. London is now, in legal terms, the global architect of digital trade law. Neofingo exports that architecture.
Powered by Ghana's 24-Hour Economy Initiative, championed by the Presidential Coordinator and the 24-Hour Economy Authority, is an ambitious national program to expand productivity around the clock, formalize previously informal economic activity, and build the digital infrastructure for sustained export-led growth.
Neofingo is, in a very real sense, the financial software for that productivity hardware. If Ghana's industries are working through the night, they need a settlement and financing system that keeps pace. Round-the-clock trade demands round-the-clock finance.
The result is a policy environment of exceptional coherence. The Bank of Ghana providing the regulatory trackway, the 24-Hour Economy Authority providing implementation fuel, the UK's ETDA providing legal foundation. Takeoff is all but guaranteed.
The African Continental Free Trade Area, the AfTA, is the most ambitious trade integration project in human history. 54 nations, a combined GDP of $3 trillion, a consumer market of 1.4 billion people.
The AfTA, Secretariat's digital platform, the AfTA Hub, is the operational nervous system of this integration ambition. And it is within the AfTA Hub that the Neofingo protocol finds its widest expression.
The AfTA Hub serves something bigger than a mere technical gateway. It is the reference implementation, the proof of concept, through which the Neofingo protocol lives and breathes. Transactions passing through the hub demonstrate, within the Bank of Ghana's policy sandbox, that the architecture works in the real world.
And the commercial architecture the hub enables goes far beyond a simple two-country corridor. Consider triangular trade, goods produced in Ghana, financed and enhanced in the United Kingdom, and sold to buyers elsewhere on the continent. Each leg of that triangle can now be financed, tracked, and settled through a single standards-aligned protocol.
Then there is diagonal accumulation. Yes, that's a mouthful, but a simple mechanism really. Under trade rules, this concept allows inputs from multiple African countries to be treated as originating from a single source for duty-free access to target markets. An exporter drawing on cocoa from Ghana, share from Burkina Faso, and packaging from Senegal can now present a single validated set of origin documents.
Therefore, collapsing barriers that have historically made producing goods with Pan-African inputs so difficult. The AfTA's rules of origin rules were always ambitious on paper. Neofingo and the AfTA Hub shall make them straightforward in practice.
Neofingo represents a new model of development cooperation, one that takes African countries like Ghana truly beyond aid. A new logic built on a commitment to those who have been locked out the longest. SME exporters, especially businesses led by women and young people, are the top priority, because if they do well, the entire society lifts up.
The dream is big indeed, onboarding 25,000 SMEs over the next 5 years, reducing their transaction costs by 40% over the period, and ensuring a tenfold increase in AISU, accelerated letters of credit issuance, And critically, boosting the exports of Ghana's largest productive base, small businesses, to scoop and pump hard currency into the Ghanaian economy at scale.
There is also a dimension that goes beyond the balance sheet. When a small business run by a woman in Tamale can access the same financial tools as a medium-sized exporter in Singapore, something changes in the story a country tells about itself.
From London to Accra, there is a community that has always held both worlds simultaneously. Nearly 300,000 people of Ghanaian heritage live in the United Kingdom. They remit money home. They trade informally. They build businesses across 2 continents using informal channels because the formal ones were never designed for them.
The London to Accra campaign at the heart of Neofingo's launch positions the corridor as their bridge. The Ghanaian diaspora in the UK, especially those importing Ghanaian products for British-based businesses and consumers, or running e-commerce operations, are an initial and natural target community.
And for British digital financial services firms, neobanks, electronic money institutions, regtech companies, trade finance software providers, the Neofingo corridor is a growth opportunity of a different kind. Ghana is a gateway to a continent of 1.4 billion consumers and a rapidly growing middle class that is choosing digital finance over legacy banking at a rate that outpaces almost every other region on Earth.
Britain's global leadership in financial services cannot rest on past glories. It requires refreshed imagination to build new connections, to take what works in London and enrich it with the push and rhythm of Accra, to bridge worlds and bond hearts.
The architecture of the Neofingo protocol is, at its core, an architecture of resilience. Each component reinforces the others. The AI compliance engine lights up the governance layer. The Bank of Ghana's policy savvy interweaves with world-class London rules.
Indeed, neither side of the corridor is sufficient, but together the system is unstoppable. The technology does not replace the governance. Through its audit trail, it cements it. Trust is the name of the game.
Exits and entries into the corridor are smoothed by the open API architecture. Every player adds value. None becomes overbearing. Trust grows with value creation, transaction by transaction.
And at the most human level, the woman sorting shea nuts in Tamale, the young exporter in Kumasi. The resilience of the protocol means that their access to trade finance does not depend on knowing the right banker, on having the right family name, on being large enough to matter. Their reputation, built transaction by transaction in the smart record, becomes their collateral. There has been much talk in recent years of a new kind of partnership between Europe and Africa, one that moves beyond the legacy of aid and dependency, one that is built on mutual interest, equal governance, and genuine respect.
Neofingo is not talk, though. It is architecture. Its governance model transcends the paternalistic and charity mindsets of old. Its open standards mean that all can contribute value. Its benefits are quantifiable, and they flow in both directions, north and south.
Britain exports centuries of legal and financial creativity. Ghana and its African counterparts bring local market knowledge, SME networks, and the scalable demand that makes the whole corridor commercially viable. Neither is the donor, neither is the recipient. Both are builders.
The Ghana corridor, the first proof of concept, carries a signal beyond its own borders. If this model works here, with this coalition of partners, it becomes a replicable template. Nigeria, Sierra Leone, Kenya, and in time, across the full breadth of the AfTA.
What Neofingo is attempting is a new model for what cooperation between Europe and Africa can look like when ambition is matched with discipline, and discipline is guided by trust. Trade finance has always been about trust. Neofingo is a new infrastructure for that trust, one that the smallest exporter and the largest institution can share equally.
If you are a business that exports, an institution that finances trade, a regulator shaping the rules, or a policymaker building the scaffolding for the next decade of African growth.
The corridor is open. The protocol is ready. And the moment is now.